Hey everybody, it's me, Gregory Mannarino. How are you today? It is Thursday, May 17th, 2018. People, it's all about, honestly, and I did a video about this just the other day, the 10-year yield. You know I hate lines in the sand, but this is acting like a line in the sand. And I want to cover that a little bit because this has the potential to lead to something. Let me know if this makes sense to you. So, as I am doing this video blog, stocks are lower, not by much. The Dow Jones Industrial Average is down about 60 points. When the market opened, stocks were higher. They were trying to push higher. However, that 10-year yield hovering where it is, it's about 3.1. Again, this is kind of like a line in the sand here for the market. And the potential here is that we could experience a sharp sell-off unless some type of intervention is instituted. Now, I'm just waiting for that to happen. If you are watching this on my website, or if you watch bond yields or what the Fed pulls out of a hat with regard to the bond market, you're probably just like me, expecting them to get into this bond market and start buying everything in sight. But there's a problem here. Can the Fed do that? Of course. That's what they've been doing now for a very long time, propping up that bond market, propping up that bond market. Subsequently, that's propped up the stock market by keeping rates suppressed. It's a crazy situation. They keep talking about how they want to raise rates, but every time they try to creep up, bam, they get in there and they start buying up bonds again to keep rates low. It's a game. They have created, and they continue, at least until now, to create a deliberate environment of risk, meaning you can't be anywhere else except in the stock market. Subsequently, it's inflated a bubble in the stock market. Now, the Fed cannot have it both ways. Can't have it both ways. They can't continue to rig the bond market like this and expect the yield curve to not continue to flatten out. So they're really in a bad spot here. If they get in, if you see today, tomorrow, or whatever, they say, okay, we're going to get in here, we're going to start buying bonds. Well, that's going to push the yield curve flatter. And I guarantee you, they do not want coverage on the mainstream financial channels of what this yield curve is doing. I mean, last night we fell under 12 basis points. It's crazy. So they are really in a situation for themselves, which they've created, and they've created for everyone else. And again, no one's going to be held responsible for this when this all comes down, and it's going to. Now, just going back to what I was saying earlier. So we got, the stocks, kind of hitting this line in the sand with regard to the 10-year yield. There's a potential there for a sharp sell-off, which could gain momentum if we start to see bonds sell off as well. You have to understand how this is going to end up playing out at one point. It's very simple. It's a concept I've covered at length, I mean hundreds of times, if not, maybe more than that. There's going to be a moment here when bonds sell off at a very rapid pace and yields spike at a very rapid pace. As yields spike like that, you get, bonds will be selling off. Subsequently, yields will spike. This will put pressure on stocks. You'll have, again, all this cash leaving the bond market, all this cash leaving the stock market. It's simply going to look for somewhere to go. It's got several avenues to go to here. Again, the number one thing is, I believe, it's going to go into commodities. It also may try to make its way over into cryptocurrencies. However, with Wall Street getting their hands on Bitcoin, they really have a corner on rigging the market now with regard to cryptocurrencies, and I've covered this at length. I've been backed up by Wall Street banks on this. I've frankly nailed it to the wall, and there's no doubt about that. So that's how I see this unfolding. So let's keep our eye on that 10-year yield and watch the bond market. Let's see what they do here. And if they get in here and they start buying up those bonds again, let's see what that does to the yield curve, because that's the only relief we have. The only relief here in this market. Now, you could listen to guys like Steve Leisman and whoever they want to parade out on the Confederacy of Dunces, and they're going to tell you that you really shouldn't be looking at the yield curve. I mean, the guy's obviously brain dead. Okay, he doesn't want to talk about how, again, the yield curve is a leading indicator. It has predicted with absolute accuracy the last 7 recessions, the last 2 stock market crashes, but they don't want you to know that. They want you to ignore the yield curve, just like in 2008. It's, again, those echoes keep getting louder. No, don't look here. Look here. Oh, ignore everything. Don't worry about it. And then, come on, really. All right, look, I know this is getting kind of long-winded, but think about these concepts and watch the 10-year yield, watch the bond market. Let's see what they do today. And again, there's a link right here in the description of this video. Take you right to my website. Underneath the chat room, you can watch a live chart of the bond market. We can see what kind of whatever they're going to do over there. All right, I'll see you later.